Hello, I'm Annie Flora, and I'm joined today by Adam Strauss from Pekin Hardy Strauss to discuss our most recent quarterly letter. Adam, what's this quarterly letter all about?
We decided to write this quarterly letter just about everything that's going on in the economy and the markets right now to try and help our clients understand a little bit more about what's happening. So we talked a little bit about the economy, a little bit about the stock market and the bond market, and then we discussed the importance of Federal Reserve monetary policy and discussed what we think might happen going forward.
And can you speak a little bit on your thoughts about the economy and the markets?
Sure. Everybody knows that inflation is extraordinarily high, but one of the things that is happening right now is that the economy is slowing at an extraordinary pace. In fact, we think it's very possible we may be in a recession right now. First quarter real growth was negative. Our best estimate is that second quarter real growth is also going to be negative. And that's sort of the definition of a technical recession. And we think that it could get worse in the second half of this year. So, the economy looks ugly with high inflation and declining real growth. And, that's affected the stock market and the bond market. In the bond market, interest rates have been going up because of inflation. And that has caused the worst start of the year for the bond market in many, many years. And then the stock market is in a bear market. It's been a difficult 6 months for the markets. And a lot of that is related to the high inflation that we're seeing and the Federal Reserve response to that inflation, where they're trying to slow that inflation. And the best way to do that is to tighten monetary policy, which in turn is causing the recessionary impulse that we're experiencing right now in the economy.
And when do you think the Federal Reserve will stop tightening monetary policy?
Yeah, it's a great question, and it's a really important question because, in our view, that's when the stock market and the bond market stops declining. Generally, the Federal Reserve has been pretty quick to pivot to an easier monetary policy once stocks have declined by 20%. But we haven't seen this kind of inflation since 1981. So they're clearly not ready to pivot yet. However, there's only so much that they can tighten monetary policy because of the indebtedness of the U.S. government, because of the indebtedness of the U.S. economy. We think that the amount of debt in the economy limits how much they raise rates. And we also think that the turmoil that we're already seeing in the markets is going to limit how long they tighten policy. So I would not be surprised to see them reverse policy, if not this summer, certainly by the midterm elections in November.
Thank you for your insight, Adam. And if you're interested in the full letter, you can find it at www.pekinhardy.com. Thank you.